Hello folks, this is Josh Robb from Hixon Zuercher Capital Management with an educational economic update for February 2018. In this month's video, I'll discuss some of the major headlines that influenced markets in January. I will also provide insight into what these developments could mean for you as an investor. January 2018 is behind us and stocks posted quite a positive start for the year. In fact, even anticipation of the first federal government shutdown since 2013 didn't derail the markets. The S&P 500 and Dow both had their best monthly performance since March 2016, with each rising over 5%. The Nasdaq gained 7.3%, making January its best month since October 2015. Several details that came out during the month indicated that a strengthening economy is driving the market performance. Initial readings of the gross domestic product, or GDP, showed the economy grew by 2.6% in the fourth quarter. Though smaller than projected, the increase still implies healthy economic growth. Corporate earnings data also suggests that the economy continues to expand. During January, many companies released their earnings reports for the fourth quarter of 2017. By the end of the month, 81% of the S&P 500 companies that had shared their earnings had beaten expectations. Also, 83% exceeded their revenue estimates. In addition to growing corporate earnings, labor measures seem to illustrate that the economy is advancing. The ADP employment report indicates that private companies added more jobs in January than analysts expected. Further, fewer people filed for unemployment in late January, keeping initial claims close to the 45-year low. Unemployment currently sits right about 4.1%, and it could get as low as 3.5% by the end of the year. And wages are finally starting to pick up too. According to the Labor Department, the Employment Cost Index, or ECI, in the fourth quarter was 2.6% higher than a year before. This increase is the largest since early 2015. When all this is examined together, you can see a growing market, increasing corporate profits, low unemployment, and rising wages. But this positive news is not without risks. If the tight labor market leads to faster wage growth, inflation could increase. At that point, the Federal Reserve could start raising interest rates more quickly than anticipated. The Fed did meet in January and decided to keep interest rates the same for now. They did indicate, however, that they expect inflation to increase over the next year, which, after the last couple years of missing the Fed's 2% benchmark, the markets have to decide how they will react to this increase, which is what we saw at the beginning of this month in February. Ultimately, we have strong growth in corporate earnings on our side, and the potential for faster than anticipated interest rates increases are on the other side. Looking ahead, we will continue to analyze the interplay between the economic growth and the inflation. Only time and data will tell exactly how these things connected together will impact the market. But we will work to keep you informed along the way. That's it for this month's Educational Economic Update. Once again, this is Josh Robb from Hixon Zuercher Capital Management, signing off for the month of February 2018. Please remember that nothing we talk about here is a recommendation. If you would like to discuss your personal financial situation, please give us a call at 419-425-2400. We'd be happy to talk with you. Have a great day.